Hello everyone, I'm Dr. Stock, Doctor of Education, and in this video we are examining the Federal Reserve's semi-annual monetary policy report, and we'll talk about what the Fed has said in that report. We'll talk about how it has impacted the markets today, and to quote Madonna singing for the soundtrack for the movie Evita, where do we go from here? And honestly, I don't know anything about that song outside of that reference. So let's move on. I want to show you something. Let's do each other a favor. Down in the description, click my link for Moomoo. By using my link, you get up to 17 free stocks when you sign up for Moomoo and you deposit $100 or more. This offer does end on 3/31, so March 31st. This offer is over. If you deposit $1,000 more, you get those 17 free stocks. So that's 2 AI draws, and then on top of that, each one of the other stocks can be up to a value of $2,000. Take advantage of the opportunity, support yourself while supporting the channel so I can keep bringing you all the information that I find that I feel is going to keep moving us financially forward. Do me one other favor. Down in the description, you'll find a link for Patreon. By clicking that link and signing up, you get access to my Patreon exclusive content and access to my private Discord. You can be a member of the community. We'd absolutely love to have you over there. So check that out. With that said, I am Dr. Stock, Doctor of Education. Let's get right into it. All right, so check this out. At 10 a.m. today, March 7th, Jerome Powell, our boy Jerome, during his testimony, read off the semi-annual monetary policy report, and I have highlighted and boxed in here for you. So red plus the yellow, this ketchup and mustard, it must be super important to really get into the meat of it. Almost sounds like a hamburger metaphor. So the full effects of our tightening so far are yet to be felt. So they know that not all of their tightening has taken place, that it's all reflected with what we see in the economy, and yet they still, and they even say it in the very next line, even so we have more work to do. So there's still more rate hikes happening, even though they don't even know how far it reaches for what they've done. What they do know is that they don't want to see inflation go out of control from where it's at. So they think higher for longer. They definitely don't want to see it go much higher than where it's at now. So I think that was a really key piece of information. We should really hang on to that. Now, moving on from there, it talks about the January data and the fact that it partially reversed some of the softening trends. We got some upward revisions, and they do mention those revisions, that's right here in this part, revisions to the previous quarter. That's October revised up, November revised up, December revised up, and then January coming in super hot. Some of which is being blamed on seasonal adjustments, but then they also mentioned the jobs report and the retail reports that were much hotter than expected as well. So the big question, and it becomes a bigger question all the time, is about the CPI and PPI coming up, because those are the last two major inflation reports that we get prior to the FOMC meeting at the end of March. So we want to watch for those. By the way, I do need to take a moment. I've been saying March 22nd and 23rd. I need to amend that. It's March 21st and 22nd. I don't know when I switched over to the wrong dates, but I did. So March 21st, March 22nd, not only is that the next FOMC meeting date, along with the probable 25 basis point hike, but we also get the summary of economic projections. And if you have not seen my video on that, make sure that you check out my video for what I anticipate the Fed to do with their summary of economic projections. I can say that I have not changed my mind based on what I've seen today in the monetary policy report. I still stand by what I said. I feel more certain about what I said. Now, mind you, we still have jobs data to watch. Like I mentioned, CPI, PPI coming out March 14th and March 15th. I absolutely have those dates correct. Those are things that we want to keep an eye on as they come out, because if they come out as hot or hotter than January, that puts us in a really bad way. Market's going to react very negatively. I will be putting out what I think the CPI is going to do very soon on YouTube. It is already available along with my research over at the Patreon. That link is down in the description. Let's move on. They do talk about PCE dropping from 7% in June down to 5.4% in January. And they talk about the decline in supply and chain bottlenecks. So moving on from there, it says, as supply chain bottlenecks have eased and tighter policy has restrained demand, it talks about core goods inflation falling. We know that from their last meeting, and we know that from the reports that we've seen. And this, I think, is really important to pay attention to, that there's flattening out in rents, so they're not inflating as quickly. So that can be good for looking ahead to housing. So be on the lookout for that. They have said that for housing, or Jerome has said that for housing, that disinflation is in the pipeline. So they believe that they've done the work. They're seeing it happen in rents, and it's only a matter of time within the next 6 to 12 months. He said it today when he was talking about it during his testimony. He said 6 to 12 months to see that housing disinflation really come into play. And that's from this current point in time, from where they've already tightened to with their federal funds rate. Now, this is also important about little sign of disinflation thus far in the category core services, excluding housing. And again, red, and then here's red and yellow, the ketchup and mustard, really get into a very, very crucial statement, in my opinion, in the monetary policy report. So to restore price stability, we will need, and I have need highlighted, to see lower inflation in this sector. So if we don't see core services, excluding housing, come down, the Fed is not changing course. So as soon as we start to see that change its course, we can start expecting the Fed to start considering changing theirs. Not necessarily changing course as soon as that does, because they're looking for a pattern. And I would say that it takes 3 reports to make a pattern. Now, mind you, we want to be on the lookout for drastic changes from what we have. So I do think that when we start to see the disinflation and possibly even deflationary pressures happening in some different areas through these inflation reports, that it's going to happen quickly, and that the Fed is also going to have to reverse course. It would be a very brief pause before they start cutting rates, especially if we see recession hit. And if that recession ends up being a little bit more than mild, if it starts to go to a medium recession, then I think the Fed really changes their tune quite quickly. So I think that they will end up finding themselves very reactionary and not necessarily ahead of the curve when it comes to having over tightened. And we're just going to have to watch that play out. He also talks about GDP being below trend, 0.9%. Consumer spending appears to be expanding at a solid pace, so not great for inflation there. Other recent indicators point to subdued growth in spending and production. So that is actually very good for us, watching subdued growth, so slowing down a little bit, and production slowing down a little bit. Not that we want it to the point where we have recession, where we have GDP decline, just a slowing down of GDP, a slowing down of the growth of the economy. That's what we're looking for, and I guarantee that's what the market's hoping for. Now, they do mention that the housing sector is weakening, reflecting the higher mortgage rates. That part, I think, was very much expected. And then higher interest rates and slower output growth also appear to be weighing on business fixed investment. Here we come with more catch-up into this. So for job openings, there's 2 jobs open for every unemployed individual. So that actually sounds like a really healthy labor market to me, and the Fed wants to see that unemployment go up. If you check out the SEP that they have from December, and you also listen to what Jerome says, they anticipate that there should be some loosening or weakening in the labor market. And again, check out my video on the summary of economic projections that I just put out a few days ago, and you can check and see what I think the Fed is going to do by that point in time. So we continue to anticipate ongoing increases, and there's ketchup and mustard again. Multiple increases in the target range is what they anticipate. The market's pricing in 2 to 3 of those already. Hopefully it doesn't turn into 4. Hopefully we start to see signs that things are slowing down, that they are disinflating, especially the services ex housing that he keeps talking about, that we see that sooner than later, so that way we can stop the quantitative tightening cycle that they're on and just pause for a little bit, let the market breathe, and actually adjust to what they've already done. And that goes back to the very first thing that they said in this monetary policy report, that they haven't experienced the full effects of the tightening that they've already done, and yet they continue to tighten anyway. Would it really hurt that much to pause? I don't know that it would. I also have underlined sufficiently restrictive. How do they know if they still haven't experienced the full effects of the tightening? How do they know that they haven't already moved past a stance of sufficiently restrictive policy? I really would like to know that. I honestly don't think that that's been adequately addressed, even if Jerome Powell thinks that he has. So this is this right here, key phrase. I'm going to wrap this up just with this statement right here. It will take time. And then it goes on to say, for the full effects of monetary restraint to be realized. Time is what it takes. And honestly, time should be that thing that, especially given all the rate hikes that they've done, let time take its place. Let the market run its course and let prices settle. Honestly, I think that they would from where they're at right now. I don't know that we need to do more to artificially slow the consumer. Pushing the economy to a point of recession, if that's what they end up doing, then that hurts a lot of people who need the money the most. The people at the very bottom, lower middle class, even the starting to get into the upper middle class, people who don't have the cushion there to absorb any sort of big recession. There's going to be suffering that goes along with it. Pause and give it the time. I don't think it's too much to ask, but like I said, that's my opinion on it, and the Federal Reserve has their own opinion on it, and well, you guys you're welcome to opine, give your opinion on it down in the comments. I'd absolutely love to hear from you and see where you stand on the quantitative tightening that we're under. Should they keep raising the federal funds rate? Should they hold steady where they're at? Should they start cutting it? Go ahead and give your opinion. I don't mind. I'd love to hear from you to see the different perspectives that we have out there. All right, real quick, finally, I want to take a look at the markets. So in my morning's video this morning, which I had some trouble with YouTube, that YouTube did not put out my video right away. It actually delayed by about 40 minutes, and so it wasn't really all that impactful. I was hoping that would have made it out sooner. However, it happens how it happens. But in that, I said that the Qs, the NASDAQ, could give up about 1 1/3%, and where we end up, about 1 1/4 down from where we were at. So I was pretty close on that one, and we did hold tight there, and I honestly think the big move is really going to be holding off for what we see from the reports next week. We got to wait on jobs for this week. We got to wait on CPI and PPI for next week. Those are going to be really telling signs. Those are going to be the next things that move the markets from where it's at right now. The sort of formation that we have building up with this doji that's up here kind of can show us that we're going on a bearish trend from that spot. Maybe it brings us back down to the 200 with all the FUD leading up to those reports. We're going to have to watch. That uncertainty could be enough to weigh us down, that we see red in the markets between now and then. And if we get the sort of reports that I think are possible to get, that they could be better than what the market's hoping for, and if it does turn out that way, it will turn green very quickly upon the CPI report coming out. And if the PPI echoes that, then that can also be another strong day for us. So we're just going to have to watch and see whether or not those January reports are one-offs, or if we see further moderation, continuing the trajectory that we saw from October, November, December, and then smoothing out a little bit into February, and then check out those revisions for January as they come out too. Hopefully, they either stay the same or they come down a little bit. We do not want them to be revised up, although February comes in mild and January revises. That's not necessarily as bad. January revises up and February is hot. That's where we run into trouble. So we want to be ready for all of those things. So watch out for them. All right, and then just a quick look at the SPY. And this was a lucky week for me. I talked about the 50-day being where we'd find that support, give up maybe about 1.5%, and today was down 1.53%. So again, if you go back and watch my morning video, listen to my commentary on that one, I talk about where we could go up to, where we could fall to. I said today, if I had to guess, I would guess sooner down than up. And, I'm not always right. I was right this time. It felt good. What I really hope that I'm right about, I got my fingers crossed on this one. So cross your fingers with me that I'm right about CPI and PPI next week coming in more mild than what we saw in January, and the market just breathing a little bit easier given that information. Then we're really going to have to look at the details when those reports come in to see where the numbers fall within the subcategories besides just the headline numbers. So I'll be picking those apart as they come out as well. All right, let me wrap this up because I know that I've been going on for a while. Where do I see the markets going from here? Honestly, they'll either go sideways, maybe a little bit up, maybe a little bit down. Honestly, I would sooner guess down than up between now and jobs reports coming out on Thursday. We'll see how they turn out for us. And then I think we'll also have that worry coming out, especially if jobs reports come out to showing that we have an even tighter labor market, or that we're just as tight as we were before. I think that's going to keep the pressure on for next week. And that pressure cooker, like the pressure building as it gets hotter and hotter and hotter, and ready to, depending on what we see. And I wouldn't be surprised to watch the markets put us at very critical points in their charts from a technical analysis standpoint, that possibly we sit on the SPY at the 200-day moving average. Maybe we sit on the 50-day, but still, I think that we're going to be put at some place of support or resistance, most likely support if we're falling downward, that given those reports, we could break one way or the other. And I think when they do come out, that I think that next week, we're going to have that big move. And there's just too much that can happen between now and then for me to even guess on the direction of the move. But like I said, if I really had to put my name out to it, I'd say maybe a little bit down, maybe a little bit sideways, pending jobs. If jobs turns out all right, then all eyes go over to inflation reports next week. So that's what I have for you guys today. Thank you for listening to my commentary. If you'd like to hear more of what I have to say, check out my Patreon exclusives by using the link for the Patreon down in the description. Also, do not forget about helping yourself out with that Moo link by clicking that, signing up, and depositing your money. You can get up to 17 free stocks. So 7 for $100, 7 free stocks for $100, 17 free stocks for depositing $1,000 or more. So thank you guys for watching. Click the like button, hit the subscribe button, ring that notification bell, say hello in the comments. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.